In this chapter, we're going to talk about recording and evaluating capital resource process activities, particularly when it comes to investing. What this means is we're going to talk more about understanding, recording, and reporting long-term asset purchases. We're going to calculate and record depreciation, depletion, and amortization. We're going to explain the impacts of these transactions on financial statements. And we're going to record the sale and disposal of fixed or long-term assets and explain the impacts of those transactions on the financial statements. And finally, we'll record and report transactions involving non-operational investments. So essentially, this is going to be like non-cash exchanges for a long-term asset. So first thing we got to understand is, what is a capital expenditure? Well, capital expenditure is when you, essentially it's investing in a long-term asset that instead of expensing it all at once, we're going to slowly expense it over a period of time, essentially turning that into an asset, not an expense immediately. So when we say we're capitalizing something, when we capitalize the cost of something, it simply means we're going to recognize that as an asset and then depreciate it over time. A revenue expenditure is just that. It's when we we create the expense in the current period. So things like oil changes, maintenance, those types of things, property taxes, all of those just get expensed in the current period, as opposed to some other type of costs which are added to the capital cost of our investment. So let's look at an example here. Let's say we purchase a truck. That's a capital expenditure. Okay, we don't want to expense that entire truck all at once. Now, the truck is going to get depreciated over its useful life. So let's say we think the truck's going to have a useful life of 10 years. So in that case, every year we would depreciate it by 1/10 of its value. However, any oil changes for the truck every 3 months, that'll be a revenue expenditure. We're going to expense it immediately. It's something that does not provide benefit over multiple periods. It only provides benefit for that singular period. Okay. So one thing to note, though, is you're going to want to add in your purchase prices, your freight charges, so that's your shipping, any sales tax, that's a one-time cost, and any installation costs. Those are all capitalized. They all become part of the asset. Okay. So when we talk about depreciation, it is simply the recognition of expense over periods of time. Okay. Instead of all at once, we do it slowly over time. There are 3 different models that we can use for depreciation. These are the 3 that we will talk about in this class. You'll use straight line, which is the easiest, most straightforward. You'll use units of production, which is typically done for manufacturing or for delivery vehicles. You'll use double declining balance. This is just an accelerated version of straight line depreciation. Okay. You need to know 4 things when you're getting ready to calculate depreciation. The first is you need to know the cost of the asset. How much did you pay for it? That cost is your purchase price plus any cost necessary to get the asset ready for use. So let's say you purchase a truck and you had to have it shipped to you, and you had to pay insurance on the shipping, and you had to pay sales tax on the truck. All of those would be costs that would be included in the capitalized cost. Okay. Then you've got to know the estimated useful life of the asset. Don't worry, you'll never have to calculate that. Somebody will tell you what the useful life of the asset is. Also, you need to know the estimated salvage value or residual value of the asset. Okay. Residual value, salvage value, they mean the same thing. Essentially, that is the value we think we could get for it if we sold it at the end, if we disposed of it at the end of its useful life. And then finally, just need to know the method of depreciation that you're going to be using. So, some terminology you need to know when we talk about these things. Carrying value or book value, okay? That is your cost less any accumulated depreciation that you have. Recall that accumulated depreciation is that contra asset account that we created to offset the historical cost or the historical value of the asset. So since we have that historical cost principle, we can't reduce the value of the asset on our books. So we simply have that contra asset account that is the opposite balance. It reduces the value of that account. That's how we report it on our balance sheet. So for instance, the balance sheet would say equipment, less accumulated depreciation, net book value, equipment. Okay, so that net book value, that carrying value, that book value, that is the cost minus any accumulated depreciation that you have. Then we have salvage value or residual value. This is the amount that you're going to recover at the end of the asset's useful life. So we will make an estimate and say, if we were to dispose of this at the end of the 10 years, we believe we would get $5,000 for it. That $5,000 is your salvage value or your residual value. Then you need to know your depreciable cost. I'll often call this your depreciable base. It is your purchase cost less the salvage value. That's the number. That is the value that actually gets depreciated. Okay. And then you need to know the useful life. Somebody will typically tell you that. That is how long we think the asset will provide benefit for us. Okay. So let's take a look at an example of straight line depreciation method. This is the simplest version here. Okay. So what we're going to do is we're going to come up with a depreciation rate. You're going to take, the way we're going to do that is to take 1 divided by the number of years that the asset will continue to provide us benefit. Here it's 5 years, so 1 divided by 5 is 20%. You could also find your depreciation cost by taking the depreciable base, right, the cost less the salvage value, and dividing that by the number of useful life. So in this case, it would be 4 or 5. So you would get $4,000 a year that you would depreciate, and we'll see that here in the schedule. Notice that straight line is the same every year. It never changes. Year 1, it's $4,000. Year 5, it's $4,000. What happens is at the end of its full depreciation, you'll end up with a salvage value on your books. Okay, so they told us the salvage value was $2,000. So once we have fully depreciated the asset, we should see $2,000. Okay, so this is simply just straight line method. Units of production is a little different. The first thing you're going to want to find when you're using units of production is your depreciation rate, your depreciation per unit, which in this case is miles. So they tell us up here in the corner that it costs us $22,000. It has a salvage value of $2,000, so we know that our depreciable base is $20,000. And then we're going to use the total miles driven, right? This is going to be our units that we depreciate by. We think that this will be able to go 100,000 miles. So you take your 20,000 and you divide it by that 100,000, and that is going to get you a units of production rate of 20 cents per mile. So all you got to do there is take the number of miles driven each year and multiply it times your 20-cent rate, and you will get your depreciation. Notice here, your depreciation changes based on the amount of units that you have used. The more units you use, the higher your depreciation cost will be. Notice accumulated depreciation is doing exactly what we expect it to, which is accumulate the total depreciation that we have accounted for over the life of the asset. Okay. Again, though, last thing to take note of, your carrying value ends up equaling your salvage value at the end of the useful life of the asset. Once you have fully depreciated your asset, your salvage value is equal to your book value. Okay. And finally, we have double declining balance method. This is an accelerated version of straight line depreciation. So where do we start? Well, with double declining, you're going to start at the straight line rate, which was 20%. You're going to multiply that times 2. We're going to double the amount of depreciation we take each year. Okay. So for us, for double declining rate or double declining balance method, the one thing that is different is that we are not going to take the salvage value into consideration when calculating the depreciation expense. So we will simply start at the 22,000 times the 40%, and we get a depreciation expense of 8,800. The next year, we take the new value, 13,200, right? And we multiply that times 40%, and you get to 5,280, so on and so forth until you get to your salvage value, okay? I made a big note down here in bold and red. The salvage value is not used in the double declining balance method. One thing you will see, and you will probably come across this in homework problem, you will probably come across this in a quiz problem and in an exam problem, is that often you will have to use what we call a plug figure here to get your last year's depreciation will just be a figure that you plug in to get to your salvage value. Okay. So let's take a look at cost allocation and depreciation examples. Let's say the STK Enterprises recently acquired a new machine at a cost of $59,000. The machine has a useful life of 6 years or 45,000 production hours and a salvage value of $5,000. During the first 2 years of the asset's life, 8,000 and 7,500 production hours respectively were logged by the machine. We want to calculate the depreciation charge for the first 2 years of the asset's life using straight line method, units of production method, and double declining balance method. Okay, so straight line pretty straightforward. This is the one you're going to see the most often. Excuse me. This is the one you're going to see the most often. This is the one that's going to be used in practice most often because it is simple. You take your 59,000, so your purchase value, less your salvage value, that gets you your depreciable base. You divide that by your useful life, and it gives us $8,000 per year. So year 1, $8,000. Year 2, $8,000. All the way through year 6, it will be $8,000 every single year. Now let's take units of production. They told us that we are expected to be able to produce 45,000 production hours with it. Year 1, we produced 8,000. Year 2, we produced 7,500. So we're going to find our units of production rate, which is going to be our depreciable base divided by the number of units. That gives us $1.20 per hour. Now we're simply going to take that rate and multiply it times the number of hours we actually used. It's going to give us $9,600 in year 1 and $9,000 in year 2. Okay, notice that your depreciation expense is based on the units of activity. Okay, the higher the units of activity, the higher your depreciation expense will be for the year. Finally, let's look at the double declining balance method and how we would calculate that. So first thing we want to do is find our straight line rate. So our straight line rate is 1/6 times, which is 16.5% or something close to that. Okay. Now you're going to multiply that times 2. We're going to double it up. Remember, this is double the straight line rate. So we're going to take the rate times 2. Okay. And that gives us 33.33%. Remember, we do not use salvage value in calculating our depreciation expense with double declining balance method. So we're simply going to take the purchase price, 59,000, times that 33.33%. And in year 1, that gives us 19,665. So 2.5 times what we did with straight line depreciation, right? And then for year 2, you're going to take your purchase cost less your accumulated depreciation and multiply it times the 33.33% rate, and you're going to get $13,110 in year 2. You will notice that your depreciation expense decreases every single year with straight line depreciation, or with double declining depreciation. Okay. So we have other ways that we account for that we allocate the cost to long-term assets. Okay, so we have this one called depletion. Depletions are reserved for natural resources. Okay, they're depleted, not depreciated. There is nothing left at the end of it, so we are depleting it. Okay. So for this, we will use the units of production method to calculate depletion expense. Okay, just like depreciation, you're going to have a contra asset account called accumulated depletion. Okay, and then we are going to take a look at an example here. So let's assume that in 2010, Dan the Hunter owns land in western Kansas. Uses it to hunt pheasants. One day while hunting, he shot his firearm, striking the ground, and oil shot into the air. Dan contacted a local oil company to survey his land, and they estimated there were over 200,000 barrels of oil that will take 10 years to pump out. The oil company paid Dan $3 million for oil rights on his land. In 2010, no oil was produced from the land, but in 2011, 200,000 barrels were produced. Record the entry for the acquisition of the oil rights. What is the depletion rate? And what is the entry for depletion in 2010? What is the entry for depletion in 2011? So oil rights. This is the company acquiring the rights to the oil. Okay, $3 million asset increase, $3 million cash asset decrease. Okay, so for the cost of barrels, it's $3 million divided by $200,000, 15 cents per barrel. There will be no entry in 2010 since they did not produce any oil from that land. And then the depletion expense for year 2 will be the 200,000 barrels that they did produce times the 15-cent depletion rate is $3,000, and then we will increase the accumulated depletion account. Amortization is much like depreciation, except we use it for intangible assets. These are things like patents, copyrights, trademarks, franchise fees. Okay, we amortize them, we do not depreciate them. We will simply use straight line method to calculate any amortization expense, but we do not create a contra asset account. We know the life of the asset, so it's not an estimate, unlike depletion, unlike depreciation, right? There's not an estimate here. We know, we have been told what the useful life of the asset is. So we know exactly how much it costs us each year, so we are simply going to expense it each year. Okay. One thing to note, goodwill, which is a type of intangible asset, is impaired. Each period is not amortized. That is a GAAP. We don't get to amortize goodwill. You have to impair it. So each year you go in and you decide whether or not it's worth your time to make an impairment calculation for goodwill. So let's take a look at an example really quickly here for on a patent. So let's say that on January 1st, 2024, STK Corporation acquired a patent for $500,000. STK feels it will use the patent for its legal life of 20 years. What is the entry to record the amortization of the patent for 2024? And which financial statement will the patent be reported on, and how much will its value appear on that statement at the end of 2025? Okay, so your expense entry on the patent is this. You're going to debit or increase your amortization expense. Take that $500,000 cost divided by 20 years. $25,000 a year is what you will have in expense. And notice we do not credit accumulated amortization. We simply reduce the value of the patent directly because we know this is not an estimate. We know exactly how much it's costing us. Then finally, it'll go in your balance sheet, right? This is an asset. It will appear in your balance sheet, and it will appear as such. Patent, $450,000. That is the $500,000 cost plus 2 years of amortization. Okay. Last topic to discuss is the disposal of PP&E, long-term assets, fixed assets. What happens when we sell these? What happens when we discard them? Okay. There are a bunch of different ways and a bunch of different reasons why you may dispose of your long-term assets. Has it become useless? Is it, are you replacing it with a new one, a more efficient one? Were you able to sell it to somebody, or is it something you just have to recycle or throw away? Okay, there are a lot of different reasons and a lot of different ways to dispose of assets. Typically in this class, we're going to discuss selling the asset as the form of disposal. Okay. Now know that you can do a non-cash exchange, so trading one washer for a new washer, or you can do a cash exchange, and a cash exchange involves a number of things. It could be a little bit of cash, what we call boot in accounting. So you may trade them your old washer plus $50 in cash. That $50 in cash is what we call boot. So that would technically be a cash exchange or a non-cash exchange with boot. Okay. So when long-term assets are disposed of, we often have to record a gain or a loss. Most times we will have to record a gain or a loss because the gain or a loss has been incurred. Now remember, a gain is just an other type of revenue, so we credit it to increase gains, and a loss is just an other type of expense, so you're going to debit it to increase the loss. Okay. The way we calculate gains and losses is to take the proceeds of the sale, the cash that you got. What did you get for it? What was the value that you got for it? In most cases, we're going to talk about that in forms of cash. So what was the cash you got for it minus the book value of the asset? That is going to be equal to your gain or loss. Now remember, when you're dealing with assets that have depreciation, accumulated depreciation as part of that calculation, you're using the book value, not the purchase cost of the asset. Okay. So let's assume that STK Corporation sells equipment for $27,000. The original cost of that asset was $80,000, and there was $60,000 in accumulated depreciation at the time of the sale. Let's record the journal entry here. Okay. So what did we get? Well, we got cash. Okay. So we're going to increase our cash. We got $27,000 worth of cash. Well, we have to get the accumulated depreciation off our books, and we have to get the equipment off our books. How do we get the accumulated depreciation off? Well, we debit it. How do you get the equipment off your books? You credit it. Okay. So that leaves us with a $7,000 gain on the disposal. Okay. So if we looked at the book value of this item would be 80. The proceeds would be 27. So you would take 27 minus 20. That gives you positive 7. Positive number for that calculation means you have a gain. Okay. So final example here. Let's look at a disposal of PPE for a non-cash exchange or a non-cash exchange with boot, whatever you want to call it. There is some cash exchange here, but it's not a straight cash exchange. Okay. So STK is purchasing a new copier worth $28,000. They're paying $20,000 in cash and exchanging an old copier with an initial cost of $25,000 and accumulated depreciation of $15,000 at the time of sale. Record the journal entry for this exchange. So again, what are we getting? Well, we're getting a new copier. Okay, that's our new asset. What do we have to get rid of? Well, we know we have to get rid of the old copier on our books and the accumulated depreciation on our books. And then what else are we getting rid of? Well, we're getting rid of some cash. To make that journal entry balance, you need $2,000 debit. That's going to be a loss on disposal. Okay. So any questions about long-term assets, disposal of long-term assets, the allocation of costs for long-term assets, just email me or ask me in class and we will discuss it.